Sunday, July 21st, 2019, Maneco 64, home of alternative economics and contrarian views. Today I want to talk about derivatives. Some of you have asked me about derivatives. Why are they off balance sheet? Why are they so risky? So that's what I'm going to do today. My background, of course, is in the derivatives market, specifically the exchange traded derivatives, which are futures and options. That's what I did for over 20 years in the city of London. So one of the first things we need to know about derivatives is that they're highly leveraged and they're side bets on underlying assets. And prior to 1999, US banks could not deal in derivatives. But with the repeal of Glass-Steagall in 1999, under the Clinton administration, that was now possible, and that's why you had banks like Citibank merging with other bigger companies. They were also able to deal in insurance. So it was what led to the whole bubble, the whole housing bubble, in my opinion. The subprime mortgage bubble was that Glass-Steagall. And one of the guys who got that through, of course, who got the ball rolling was Robert Rubin, who was Secretary of the Treasury under the Clinton administration, and also Larry Summers, who was the Secretary of the Treasury at the time that Glass-Steagall was repealed. So how was Robert Rubin rewarded? Well, he was given a cushy job at Citigroup, and I think he left after the financial crisis with over $100 million of taxpayer money. And why do I say that? Well, because Citigroup was bailed out by the taxpayer. And of course, Robert Rubin started out at Goldman Sachs, and he was also the CEO of Goldman Sachs prior to becoming Treasury Secretary. So that's a little bit of the background there. Just one thing I wanted to say. I've got a book here. It's Barron's Finance and Investment Handbook. It's a very old book. I bought it back in the late 80s. I think the edition is from 87 when I started looking at markets. And I've just gone through the index. And I went under D to look for derivatives. And there's nothing about derivatives. And this is 1987. You can see that it's something that wasn't part of the system back as recently as the late 80s. But now it's the most important part of the system, of the banking system, I would say. So I can show it to you here if you don't believe me. Let's see if you can see here. There's no derivatives under D, nothing. So that just goes to show you how this is not a normal, I would say, state of affairs. And even Jim Rickards, I've heard him say that derivatives should be banned. So I worked in exchange-traded derivatives. What's the other kind? Well, it's the over-the-counter derivative, or OTC, which is not a public market. It's counterparty to counterparty. They call each other and they say, I want to do this. And they draw up some kind of contract, private contract. It's not public. In the exchange-traded derivatives, as the name says, exchange, all the transactions are public. There's public data published, as you know, the COT report, commitment of traders by the CFTC. There's volume of trade. The contracts are standardized, but not in OTC. They basically banks calling each other, writing derivatives, clients calling banks, and they just draw up anything. I recommend you watch The Big Short, and you'll see what I mean when the fund manager from California travels to New York to get a derivative created on mortgage-backed securities, which hadn't been done before. And all the big Wall Street banks obliged, and they thought it was a joke. And they wrote him huge contracts, and that they thought would never really basically work. So they didn't think of the risk. So I'm going to go through Wikipedia about derivatives and the criticisms of derivatives. And I'll just read through here. It says, according to Raghuram Rajan, former chief economist of the IMF, it may well be that the managers of these firms, investment funds, have figured out the correlations between the various instruments they hold and believe they are hedged. Yet, as Chan and others, 2005, point out, the lessons of summer of 1998 following the default on Russian government debt is that correlations that are zero or negative in normal times can turn overnight to one, a phenomenon they term as phase lock-in. A hedged position can become unhedged at the worst of times, inflicting substantial losses on those who mistakenly believe they are protected. Well, what happened in 98? Well, we had LTCM, a hedge fund that went bust because of this Russian default triggered all these risks that people think didn't exist. What about risk? It says the use of derivatives can result in large losses because of the use of leverage. That's the main risk. You see, when you trade a futures contract, let's say the futures contract on gold, on COMEX, you control, let's say, $140,000 because one contract is 100 ounces. But you only have to put down maybe 5,000 or 6,000. I'm not sure what the margin is right now. So there's very little that you have to put down. The rest is all leveraged or borrowing. So it says derivatives allow investors to earn large returns from small movements in the underlying assets price. However, investors could lose large amounts if the price of the underlying moves against them significantly. There have been several instances of massive losses in derivatives markets, such as the following. AIG, American International Group, lost more than 18 billion through a subsidiary over the preceding 3 quarters on credit default swaps, right? That's when they had to be bailed out by the US Treasury, AIG Financial Products. The loss of $7.2 billion by Societe Generale in January 2008 through misuse of futures contracts. The loss of $6.4 billion in the failed fund Amaranth, September 2006, and the list goes on. The other thing that people ask me is, why are derivatives off balance sheet? And to be honest, I'm not too sure why they keep it balance sheet. The only reason why is that it's such a huge, how can I say, risk that they don't want to keep it in the balance sheet. It's like side bets. So I don't understand. I always thought that was strange. I was always told when I first learned about derivatives in the late 80s, like early 90s really, that's when they started coming about, that they were off balance sheet. No one questioned anything. Well, they're off balance sheet. So I just wanted to show you that this risk hasn't gone away. The banks, if anything, are still at it. I'm not making this up. I've got information here, the latest data from the OCC.gov website. And you can see here that JP Morgan has 71.5 trillion in notional derivatives amount. That's including over-the-counter and exchange-traded. Citibank, you can see, they've got 45.8 trillion. Bank of America, they've got 20.7 trillion. Goldman Sachs, 38 trillion. And Wells Fargo there, 10 trillion. So together, all these major American banks have almost 200 trillion in derivatives. U.S. economy, of course, is about 20 trillion a year. So 10 times the U.S. economy, just the major banks in the U.S. So you can see why it's risky. And the other thing that might upset you now is to know that this derivatives market is actually backed now by the FDIC or the taxpayer. Why do I say that? Well, this happened 5 years ago or 4.5 years ago. Here's a an article here from motherjones.com. Citigroup wrote the Wall Street giveaway the House just approved. The bill, drafted almost entirely by Citigroup, would allow banks to do more high-risk trading with taxpayer-backed money. Update Friday, December 12th, 2014. And goes on to say, on Thursday night, the House passed the spending bill with the Citigroup written provision. The Senate is expected to approve the legislation. A year ago, Mother Jones reported that a House bill that would allow banks like Citigroup to do more high-risk trading and with taxpayer-backed money was written almost entirely by Citigroup lobbyists. The bill passed the House in October 2013, but the Senate never voted on it. For months, it was all but dead. Yet on Tuesday night, the Citi-written bill resurfaced. Lawmakers snuck the measure into a massive 11th hour government funding bill that congressional leaders negotiated in the hopes of averting a government shutdown. President Barack Obama is expected to sign the legislation. So this is a comment here, not from me, but from Marcus Stanley, the financial policy director at the advocacy group Americans for Financial Report. So this is what he says. This is outrageous. This is to benefit big banks, bottom line. So there you go. Even these derivatives now are also, the banks are protected with FDIC insurance, even for this, so what else does it say? As the author says here of this article, as I reported last year, the bill eviscerates a section of the 2010 Dodd-Frank Financial Reform Act called the push-out rule. So I'll keep going. It says, banks hate the push-out rule because this provision will forbid them from trading certain derivatives, which are complicated financial instruments with values derived from underlying variables, such as crop prices and interest rates. Under this rule, banks will have to move these risky trades into separate non-bank affiliates that are insured by the FDIC and are less likely to receive government bailouts. The bill would smother the push-out rule in its crib by permitting banks to use government-insured deposits to bet on a wider range of these risky derivatives. The Citi-drafted legislation will benefit 5 of the largest banks in the country: Citigroup, JP Morgan, Chase, Goldman Sachs, Bank of America, and Wells Fargo. These financial institutions control more than 90% of the $700 trillion derivatives market. If this measure becomes law, these banks will be able to use FDIC money to bet on nearly anything they want. And if there's another economic turndown, they can count on the taxpayer bailout or of their derivatives business. So yeah, this was signed into law. So next time there is a crisis, and I think we're pretty close to it, you, the taxpayer, will be on the hook for it again. So that's what derivatives are. They're just very risky, leveraged side bets that have no real social, value to society. And the people who benefit from it are the people in the banks, the people around the banks, the people who deal with the banks, the City of London, Wall Street, but not the general public. The general public, of course, will foot the bill once this hits the fan again, like it did in 2008. So that's what derivatives are, and they're still around. They're still really risky. They're off balance sheet, and I would say that 200 trillion number is probably even higher because they changed the accounting after the 2008 crisis to make it seem like they have less in notional amount. If you enjoyed this video, make sure you hit the like button, subscribe to the channel if you haven't yet. You can also follow me on Twitter, Steemit, and on DTube. I wish you all a great day. Take care. Bye.